Tasty bites, smaller accounts, somewhere between 2,500, 25,000, that kind of thing. So the team put together a piece called Synthetic Options, a capital efficient alternative. Let's see where the research team's going with this one. So trading stocks requires substantial upfront capital. Consider this: buying 100 shares of Amazon at $225 per share will require $11,250 in a regular margin account. That's putting up half, borrowing half. This creates a significant barrier for many small accounts, for account traders who want market exposure without heavy capital requirements. One of the reasons I just traded NVIDIA, because in NVIDIA, it's $171 stock, so you would have to put up a little over $17,000 if you without margin, and a little over $8,500 with margin. That's expensive if you have a $10,000 account. So synthetic positions offer a capital efficient alternative to direct stock ownership, and it could be long or short. It doesn't matter. So instead of buying the shares outright, we can create a similar market exposure using a combination of options. So long a call and short a put is the equivalent of long 100 shares, and short 100 shares is short a call and long a put. It's the exact same thing. We call those combos, and those combos are long or short synthetic stock. And you can use any strike you want. It's not 100 shares, but whatever delta you pick, that's the number of shares the equivalent is. Let's go to the next slide. So since option positions are much more flexible than simply long and short stock positions, we can adjust the deltas on either the put or call sides to meet our requirements. So at a minimum, we want to collect a credit at the order entry so we don't lose time value. At the money synthetic positions closely mirror, they're actually perfect, positions with a delta of nearly 100, providing almost the same directional sensitivity as owning 100 shares. Yeah, they're literally one for one. When those things all expire, they're gonna flatten out. Long call, short put, and your underlying stock, they're just gonna all offset. So the pop remains around 50%, similar to stock ownership, and the risk reward profile maintains a linear relationship that matches the stock performance. The key difference is capital efficiency, allowing us to achieve equivalent exposure with a much lower capital requirements. The BPR for Amazon synthetic is 5,600, about 50% of what's required for long 100 shares of Amazon. You're saying, well, why is that? It's a different margining system. That's all it is. Stocks have
Makes
one
sense.
and options have another.
Yeah, and different regulatory. Yep.
No, same regulators, just different margining system. So when using out of the money options, instead, it can also improve your position in several ways. It further reduces the BPR, which is 3,900 for 30 delta options in Amazon. And out of the money synthetics typically have lower delta, 75 in the example we have on the screen in front of you, which reduces the directional risk while providing meaningful market exposure. So you don't have to be 100 deltas. You could be 80, 70, 60, 50, 40, 30, whatever you want. And it just requires less capital if you do that, because obviously you're taking less risk. The probability of profit increases to 65% compared to 50 with out-of-the-money options or stock positions. If we enter the out-of-the-money synthetics for credit rather than paying a debit, it slightly improves our risk-adjusted returns. The trade-off is a different risk profile between the two strikes. It requires the stock to move above our long strike to be profitable at expiration. So the major benefit of trading synthetic positions is the reduced buying power. We're all about capital efficiency. And the reason you would do this is just liquidity, capital efficiency. Here's the pros of synthetic. Lower buying power, potentially higher return on capital, and a better probability of profit. The long stock, way easier to manage. The cons, they'll expire and you need to roll the position. And the cons on stock is high buying power, and it's always a 50-50 shot. That's it, 50-50. Several important factors need attention when managing synthetic positions. The position delta fluctuates continuously with the stock and as time passes. So unlike stock positions, which have a constant delta of 100 for holding 100 shares. And then the other one is at expiration, the delta becomes either 0 or 100, depending on where the stock closes relative to the strike prices. So traders may need or should close or roll the positions in the same synthetic position And you have to do that just to eliminate a bunch of the risk.
Yep.
Let's go to the last slide and take a look at some of the takeaways. So synthetic strategies provide an effective alternative to stock. They significantly reduce buying power and improve win rates. And they're super simple to use. And these positions allow traders to modify directional exposure and risk profile more easily than traditional stock holdings. More active position management is essential for synthetic positions. What these guys are describing here is our entire life, just so you understand.
That's correct. I was just going to say that you have to be able to look at a position and know what you're synthetically long or short also, just by looking at the position.
This is all we've ever done is, use synthetic strategies as an alternative to stock to modify our pop.
If you're not subscribed, subscribe right here. And if you want to meet me and the team in person at our next live event, hit the link at the top of the description.